When you place a trade entry using smart money and liquidity concepts, price hits your stop loss. Basically, you become the liquidity for the market. But why? This happens to you because you are marking the liquidity in wrong way. And most probably, you don't even know where the real liquidity lies. Therefore, in this video, I will teach you how you can identify the right liquidity so that you can avoid taking unnecessary losses while trading. This will benefit you to increase your trading profit curve. To help you apply the concepts easily on your charts, I have divided this video into two parts, theoretical and practical chart applications. The practical part is the most important because in that I will show you the secret method that I use to avoid losses, so make sure you don't miss that part. Hi, I am Priyanshu Songara, a full-time forex day trader, and let's get started. Before learning how to identify liquidity, you need to understand what is liquidity and its different types. Basically, liquidity is money. When money is involved in any business, the big hands do the manipulation for their advantage, and that's what liquidity helps us to understand. When a trader enters into a position, he puts stop losses based on the strategy that he uses. Market algorithm takes out his stop losses, then move to the correct direction for more liquidity. This occurs when majority of traders put their stop losses at the same level. Price generates liquidity, then take it out, and the cycle repeats. Hence, liquidity plays a significant role in moving market prices. How do you find the liquidity? Since liquidity implies stop losses of people, so you need to identify where are the stop losses of majority of traders. Obviously, neither you nor I have the access to the data of trade orders, so how do you know where are the traders' stop losses? The best way to find it is by knowing what are the types of strategies that different traders use to enter and exit in the market. By doing so, you will know where are their entries, stop losses, and targets. There are three trading styles used by majority of traders. So liquidity is classified into three types, and the third one is my favorite and very helpful to you. So make sure you don't miss that out. Now let's understand them one by one. The first type of liquidity is of support and resistance traders. I'm sure every one of you have used this concept in your trading at some point or maybe still using it. But how do these traders involve in market? Let's see. There are two ways in which SNR traders enter into a trade. Firstly, they wait for candlestick patterns at these support and resistance areas, and secondly, they enter after a breakout of a level happens. If it's a trend continuation, these traders often look for break and retest of that level as the entry. The stop loss placement in these cases will cover the recent swing formed at the entries. If you knew about support and resistance trading, then you must also be aware of a second type of liquidity. You guessed it right. The next type of liquidity is of trendline traders. Let's learn how these traders involve in the market. Trendline trader, just like SNR traders, enters in two ways. The first one is trading at the trendline touches, and the second way is through breaks of trendline. The stop losses placement in this case will cover the recent swings formed at the entries. The practical chart example of these two types of liquidity is shown. In the first schematic, we have three touches that forms a trend line buildup, and in the below schematic, there are equal highs and equal lows buildups denoting support and resistances. The two types of liquidity that we just studied are commonly taught in smart money concept trading. But you may be asking, what is the third and most important type of traders liquidity? To your surprise, this liquidity comprises of SMC traders itself. Since SMC trading has become very popular because of social media, more and more people are getting to know about it rapidly. So there is a simple rule in trading. If something is used by masses, then that thing will surely get manipulated. Now let's see how to spot SMC liquidity. SMC traders wait for market to give structure breaks and forms a zone or order block which they use for placing a trade entry. The stop loss placement is above below the order block zones. Here comes the end of our theory part. So if you want this PDF for free, like this video because at 50 likes, I will provide the download link. At this point, you have a complete theoretical knowledge of liquidity, but how you will apply everything on charts and improve your win rate? So let's get into the most important part of this video, the chart practice. This is Euro USD chart on 5-minute time frame. We will analyze this chart by questioning where is the liquidity. As you can see clearly, there is this equal buildup support. Price also created this trendline liquidity with three touches. SMC traders will look for a structure break. Price also created this change of character. So this will be the order block for the SMC liquidity. Let's mark it as a trap zone. This is also a trap zone. SMC traders got induced over here. Price created a SMC liquidity at this point. This trap zone was invalidated by the price. As you can see here, price gave another structure break, so people will be looking to get a sells at this trap zone. Price took out this SMC liquidity and trapped every of these sellers. On again analyzing, you can clearly see that market broke the structure to the upside. So this will be a trap zone and this zone will be the extreme trap zone. Price also created equal buildups. Since price mitigated this SMC trap zone, so it's a liquidity. Playing the price forward, you can see price created a reaction for the early buyers, induced them and created a liquidity for this extreme zone, which is a trap. Price gave a good bullish reaction to induce SMC traders and let's see what it will do. Price took out every SMC trader, giving a structure break to the downside. This is a trap zone. This is also a trap zone. Price created this liquidity for the trap zone. This is also a trap zone for internal structure break. After this is taken, since price mitigated this trap zone, this will become SMC liquidity. So price can move upside. For the trend line liquidity, price has created the 3 touches trend line. So yes, the liquidity is upside with trend line and SMC traders. Playing the price forward, price gave another structure break to the downside and these are the trap zones that everyone will try to get an entry. Price gave a reaction and went upside, touching this extreme zone. If anyone will consider this as the liquidity, selling, they will look for the sells inside this trap zone. Or if anyone will consider these as the liquidity, they will try to get a sells from there. Let's see the price. Price didn't react it from here, not from here, prepping everyone and not even from here. So this is how SMC traders are trapped, even though they identified the liquidity and order block, but they got liquefied. The reason is order blocks is liquidity. Playing the price, you can see clearly that same thing happens again. Price gave the structure break, price formed the order block area, which is a trap, and didn't respected it. That's how the market is working. Now, the secret method that I use to avoid losses includes two rules. The first rule is identify the liquidity, and if it's present close to your entry, wait for it to get taken out. The second rule is avoid using SMC order block zones as your entries. As you can see the results on the chart, the SMC order blocks do not work. They induce the traders and liquidate them. Instead, wait for liquidity to get taken out. I hope that through this video, your eyes are opened about the order blocks and the SMC liquidity concepts. You have learned A to Z of liquidity and how to use it for your advantage. But if you want to learn about the order blocks, you can click and watch the video appearing on the screen. I'll see you there. Bye.